So as we kick off the European segment, we really want to look at what are some of the expectations that have shifted, how have they changed, and what is the ECB's reaction going to be? One of the things that we've been saying for a very long time is that, central banks have pinned themselves into a corner. Maintaining poor policy or terrible policy for so long with so much liquidity, so much for no real reason per se. Now, when they really need it, they have no choice but to keep things tight, keep rates moving higher, because we're at such a point that there's so much liquidity still sloshing around, still so many issues on the inflation side because of this poor monetary policy that they're really stuck at this rising rates, even as construction activity slows, as economic activity comes under pressure. So when we look at just the CPI expectations, you can see them slightly moving higher on a 1-year, 3-year projection, which, as we know, they've been wrong already. So the fact that they're taking it higher, for those that remember, we were showing charts how they had doing this complete reversal, that it's like, oh, it's going to peak and then drop off a cliff. And we're like, that's not how inflation works after you've been having negative rates for the last 10 plus years. So industrial production, slightly better in August, but we know it got a bit worse in September. Trade balance, fairly stable. Survey expectations, a bit better versus the negative number in September. CPI inflation. CPI came in at right in line with estimates of 4.3, month on month up 0.3. So again, that trend higher continues. Construction output negative 1.1. So again, another layer to the downside. But one of the interesting things is the portion of high yield market maturing in 3 years is much bigger in Europe. And that's going to be a bigger issue when you start looking at flows, because they have a bigger wall than what the U.S. has. So the U.S. obviously is going to have to deal with rolling maturities, but Europe has more and more to deal with. And based on the sheer size of almost 40% of that market has to be rolled, well, 40% of the market has to be rolled to much higher rates. And a lot of that was done at negative rates, let alone low rates. Some of them were negative. So now what? Now as you get this pushback higher, what does that mean? What does that lead to? And that's why we see more pressure to the upside. And you're seeing it in bonds. The French 10-year is going back to 2012 highs, 2011 highs. If you remember the fear of contagion during that period. The Italy to German 10-year bond spread continues to go up because, again, Italy's the one that's at risk. So Italy is the let's call it the softest point when you look at some of these risks, just given their debt to GDP ratios and the problems that persist. Eurozone industrial production, again, coming in at 104.7, fairly flattish. Manufacturing dropped already, but then kind of bounced. We know that it does take another leg down in September. Industrial production year on year expected at negative 3.4, came at negative 5.1, and then manufacturing production year on year. So again, you're seeing these levels, again, moving down, moving lower, which creates a lot of these pressure points. Euro area industrial production ex construction, which, remember, construction was the biggest drawdown. So now industrial production, with not even considering that, is already negative. So then when you look at that public debt and its weighted average maturity, you get an idea of why we talk so much about Italy and just where that levels are and those problems are, because the years are not going to be favorable, because Italy is looking at short duration public debt percentage of GDP. Obviously, you have Spain, Portugal, France, Greece. When you look at it in general, Germany is okay, in terms of the average, but that's why when we talk so much, it's always Italy that we're talking to, because the duration is the problem, because that's where they're going to get caught. France has a little bit more running room, but people, and by people, investors, are going to go after that soft underbelly, which really falls under the Italian mark. So then when we start turning to the most recent economic data, again, CPI staying elevated, right in line with our expectations. Wholesale prices on a month-on-month basis, staying elevated. Survey expectations expected at negative 9, came in at negative 1.1, slightly better. Current situation still seemed under pressure. France actually saw some of their inflation cool a bit, but on a year-over-year basis actually get a bit worse. Then when you start looking at confidence, the business levels and some of these surveys, business confidence missed estimates by a point, coming at 98. Manufacturing confidence came right in line at 98. Production outlook came in a bit worse at -10. And then the overall business survey for demand came in at -2. So again, all the while you have ECB that's stuck kind of pushing rates higher, and you see some of these things again pulling back down and moving lower. Spain had their inflation continued to move higher. Core, slightly less than expected. But when you look at the pressure points, Spain is kind of in the no man's land where there's more pressure on Italy and France. Germany, again, on an economic basis is terrible, but in relation to their debt load, it's manageable. The problems are really coming down to the Italy and French side. When you look at the surveys, CPI in Italy got a little bit better, coming in at 5.6%, but realistically, you're still seeing some of those increases, which is why we see Italy being under the gun when we start looking at some of these underlying flows. So that's what we have for you today in Europe. It's a fairly quiet market right now from the European data standpoint. We will get a little bit more data as we go into next week. The biggest issue remains, what does the ECB do? And because they're showing you they expect rates to go up again, inflation to go up again, that will again push the ECB to keep rates moving higher and the pressure intact. So in the next segment, we're going to go deeper into Asia, and we're going to kick it off with China.